What if the biggest shock to the global economy in the 2010s didn't come from a war, a financial crash, or a pandemic, but from something the world thought it understood better than almost anything else? Oil. What if the most powerful energy producers on Earth saw the collapse coming, had the ability to slow it down, and chose not to? And what if the price crash of 2014 wasn't an accident at all, but the moment the modern energy order quietly broke, reshaping geopolitics, finance, and power in ways we're still living with today? For decades, oil had obeyed a familiar story. Prices rose when supply tightened, they fell when demand weakened. Crises followed wars, embargoes, or sudden recessions. Analysts believed the system was messy, but legible. Then, starting in the summer of 2014, oil prices began to slide. At first, it felt routine. A few dollars here, a few dollars there. Commentators shrugged. Markets adjusted. But month after month, the slide didn't stop. By the end of the year, oil had lost more than half its value. Entire economies went into shock. Trillions of dollars vanished. Governments collapsed. And the energy world that emerged afterward was fundamentally different from the one that came before. To understand why this happened, you have to rewind the clock to a time when oil felt unstoppable. In the early 2000s, global demand surged. China was industrializing at breakneck speed. Emerging markets were urbanizing. Cars, planes, factories, and shipping lanes all drank crude at unprecedented levels. At the same time, supply felt constrained. Years of underinvestment, political instability in key producing regions, and the lingering memory of past oil shocks convinced markets that oil was scarce. Prices climbed steadily, then explosively. By the late 2000s, oil crossed thresholds once thought impossible. $100 per barrel became normal. Then it climbed higher. Energy exporters accumulated massive surpluses. Oil companies became some of the most powerful corporations on Earth. Governments built budgets assuming high prices would last forever. But beneath the surface of this apparent boom, something new was forming. In the United States, a technological revolution was quietly reshaping production. Hydraulic fracturing and horizontal drilling unlocked oil trapped in shale formations once considered unreachable. At first, this shale boom looked fragile. Wells declined quickly. Costs were high. Many analysts believed it was a temporary blip that would fade once prices fell. But prices didn't fall. They stayed high, and as they stayed high, technology improved. Drilling became faster, cheaper, more precise. By the early 2010s, American oil production was surging at a pace not seen in decades. The United States, once assumed to be in terminal decline as an oil producer, was suddenly adding millions of barrels per day to global supply. This is where the first twist appears. Historically, when supply surged, someone cut back. For most of the modern oil era, that someone was OPEC, and especially Saudi Arabia. The kingdom had long played the role of swing producer, adjusting output to stabilize prices. It had done so in past crashes, sacrificing short-term revenue to preserve long-term stability. Markets expected the same response again. As shale output rose and demand growth slowed after the global financial crisis, many assumed OPEC would step in, cut production, and defend prices. But this time, Saudi Arabia didn't blink. Instead of cutting, it increased output. In late 2014, OPEC meetings ended without meaningful production cuts. Saudi officials sent a clear message. They would not act alone to support prices. The market was stunned. Prices collapsed faster. Analysts scrambled for explanations. Some argued the kingdom wanted to defend market share, forcing higher-cost producers, especially American shale, out of business. Others believed it was a geopolitical move, aimed at weakening rivals like Russia and Iran, whose budgets depended heavily on oil revenue. Some thought it was simply a miscalculation. The truth is more unsettling. It was all of these things at once. Saudi Arabia understood something the market had not fully absorbed. The old oil system was breaking. Shale had changed the rules. Cutting production no longer guaranteed higher prices. Any reduction by OPEC risked being replaced almost immediately by American producers. The kingdom faced a choice: continue propping up prices and lose relevance, or let prices fall and test who could survive in the new world. It chose the latter, and when it did, the dominoes began to fall. Oil prices, which had hovered above $100 per barrel for years, plunged below 50, then 40, then lower. Exporting countries that had built social programs, subsidies, and political stability on oil revenue were suddenly underwater. Venezuela, already mismanaged, entered a full-blown economic collapse. Russia slid into recession. Nigeria's currency cratered. Even wealthy Gulf states burned through reserves at alarming rates. Oil companies slashed budgets, laid off workers, and canceled mega projects once thought inevitable. But perhaps the most dramatic fallout occurred in the financial system. During the boom years, cheap credit and high prices had fueled massive investment in energy. Banks, hedge funds, pension funds, and private equity poured money into oil and gas projects. High-yield bonds issued by shale companies became a staple of financial markets. When prices collapsed, those bonds imploded. Defaults surged. Entire portfolios were wiped out. In some regions, like Texas and North Dakota, the crash felt eerily similar to a localized financial crisis. Jobs vanished. Housing markets stalled. Towns built around drilling booms went quiet, almost overnight. Yet here's the second twist. Shale did not die. Instead of collapsing under low prices, many American producers adapted. They renegotiated contracts, focused on their best wells, cut costs aggressively. What had once required high prices now worked at much lower levels. By the time oil began to recover, shale was leaner, faster, and more resilient. The very strategy designed to crush it had hardened it instead. This forced another shift. OPEC, once the unquestioned price setter, found itself reacting to markets rather than controlling them. In the years after the crash, new alliances formed. OPEC partnered with Russia and other producers in an uneasy coalition known as OPEC+, attempting to regain influence through coordinated cuts. Sometimes it worked, sometimes it didn't. The sense of control that defined the 20th century oil order was gone. And then there's demand. One of the least discussed but most important consequences of the 2014 crash was how it intersected with the energy transition. Cheap oil slowed investment in alternatives. Electric vehicles, renewable energy, and efficiency improvements faced tougher economics when gasoline was cheap. But at the same time, the crash exposed the fragility of oil-dependent economies and business models. Investors began asking harder questions. Governments started thinking about diversification not as an abstract goal, but as a survival strategy. Look at the data that followed. Global oil investment fell by hundreds of billions of dollars. Exploration budgets collapsed. Major discoveries dwindled. At the same time, renewable energy costs plunged. Solar and wind became competitive faster than almost anyone predicted. Electric vehicle adoption accelerated. The world didn't abandon oil overnight, but the assumption of endless growth cracked. This brings us to the deeper pattern, the one that keeps repeating. Every major commodity boom carries the seeds of its own collapse. High prices invite innovation. Innovation creates supply. Excess supply destroys prices, and the crash reshapes power. In the 1970s, it was OPEC's rise. In the 1980s, its fall. In the 2000s, oil's resurgence. In 2014, its reckoning. What made the 2014 collapse different was that it wasn't triggered by a single shock. No war shut down supply. No embargo choked trade. It was the slow, grinding consequence of technology, strategy, and denial colliding at once. Markets assumed someone was in control. No one really was. And we've seen echoes of this since. During the pandemic, oil prices briefly went negative, revealing how fragile pricing mechanisms had become. In the early 2020s, prices surged again amid geopolitical tensions, reminding the world that oil still matters. Yet beneath those swings, the same question lingers. Who sets the rules now? The answer is uncomfortable. No single actor does. Not OPEC. Not the United States. Not markets alone. The oil system is now faster, more volatile, and more politically entangled than ever. Supply responds quicker. Demand shifts unpredictably. Financial capital moves at lightning speed, and the margin for error is thinner. So what are we supposed to learn from the 2014 oil price collapse? First, never mistake stability for permanence. High prices felt normal until they didn't. Entire economic models were built on assumptions that evaporated in months. Whether it's oil, housing, technology, or artificial intelligence, systems that seem solid are often balanced on fragile expectations. Second, technological change doesn't just disrupt industries, it rewrites power. Shale wasn't just a new way to drill. It transformed geopolitics, weakened cartels, and redistributed leverage across continents. Today, similar dynamics are playing out in batteries, semiconductors, and energy storage. Third, attempts to control complex systems often backfire. Saudi Arabia's decision not to cut production was rational, strategic, and defensible. It also unleashed consequences no one fully controlled. The lesson isn't that strategy is useless, it's that in tightly connected global systems, outcomes rarely obey intentions. The warning is this: the next energy shock will not look like the last one. It may not come from oil at all. It may come from electricity grids, critical minerals, or climate-driven disruptions. And when it does, the same human instincts, overconfidence, delayed response, faith in old playbooks will be there, waiting to repeat history. The open question is whether we'll recognize the pattern sooner next time, or once again convince ourselves that this time is different. If you want more deep, cinematic breakdowns of the hidden forces shaping the global economy, energy, and power, subscribe to the channel. These stories don't end when the headlines fade, and neither should our curiosity.